Welcome to the Lane Gorman Trubitt COVID-19 Financial Webinar Series. In this series, our accountants and advisors will provide you with information to make sure your business has the tools it needs to survive the 2020 coronavirus lockdown. This webinar is about the important changes to the PPP loans forgiveness guidelines from the Paycheck Protection Flexibility Act. It was recorded live as a Zoom webinar on June 25th, 2020, and all information was accurate and up to date at that time. There is a Q&A at the end, but if you have any questions, please feel free to email us at askus@lgt-cpa.com and we will get back to you as soon as possible.
I'm Colin Kinelakis with Lane Gorman Trubitt. I'm a partner. I've also joined with Denver Todd, Senior Manager, and Patrick Riley, Partner. Patrick will be moderating the end of the webinar. We do have a disclosure statement that I'll let you read yourself, which basically helps explain that we are providing the information that's more general guidance, and your specific situations might result in different answers. You know, we certainly appreciate all of you joining us. Background on the firm: we're an independent firm located in the Dallas-Fort Worth area. We service clients all over Texas, and we have clients pretty much all throughout the United States as well. We've been around for 70 years. Been going strong, and if you've joined us on prior presentations, we've had multiple PPP COVID-related webinars, and so we're happy to present you an update. The agenda today will start out by giving you a high-level update on the Payroll Protection Program, otherwise known as PPP. We're not going to go into all the details because we've had multiple of these seminars before. Those seminars or webinars are still available. We have a resource page that will be shown towards the end, and you'll be able to see that, follow the link. I'd love for you, if you have more questions about the details and nuances, you can go back and listen to those webinars, and they'll provide you all of those more basic items. We'll then go over some recent SBA and Treasury guidance, and then we'll go over the forgiveness application. And many of you probably know this, but there are actually two different applications. There's an easy, which actually is a much easier version. You have to qualify for it, and then we will walk you through that qualification. Then we have a basic forgiveness application. And yes, it is a little bit different, not too different, but is a little bit different from what you saw in the initial forgiveness application. Then we'll go over the loan forgiveness process with lenders. There's still a lot of questions there, but we'll talk to you about some of the best practices. Then we'll wrap up with some common mistakes and questions that we deal with and we've experienced in working with and advising our clients. All right, so timeline. June 5th, the President signed the Payroll Protection Program Flexibility Act 2020. This is where we got some good information and expansion. Again, we're talking about what's new, not everything from the beginning. So June 16th, there was released a revised loan forgiveness application, and that's both the easy and the regular. And then there were revisions to the interim final rules. So we're still dealing with interim finals, so we'll see if we get final, but this is where we are now. June 11th, there were revisions, sorry. June 12th, there were additional revisions. June 17th, they had additional. And then on the 22nd, not too long ago, they had some additional revisions. So as you know, we haven't done one of these webinars for a little while. Why? Because there's so many revisions that we knew were coming. Many of them we're still waiting on answers on many things. So look for Q&A, look for frequently asked questions, and if there are significant items that come up, we will certainly look at doing another update. Give you some high-level changes here. So initially, there was an 8-week period that is loosely a 10-ish week period when you consider the fact that it's cash basis on the front end and accrual on the back end. So any borrowers who receive loans prior to June 5th, they have the option of these two different periods. You can do the 8-week period, or you can do the 24-week period. Now, if you got your loan June 5th or later, you actually have to use the 24-week covered period, which starts with the date the loan proceeds are received. Now, the deadline for PPP loan application continues to be June 30th, and that's coming up pretty quick. Now, unless there's an extension, there will not be additional applications accepted for PPP loans after that date. The other key item is we've always worked off of the 75-25 rule, where at least 75% of your forgiveness component needs to be payroll related. In these amendments, they updated it to 60%. And that allows more overhead intensive companies to get more of their rent forgiven. So that's kind of nice for some companies, had zero effect on some others. There was this, we've talked about several times before, where you had some options where if you had to reduce your full-time equivalents or you had to reduce your wages for people, you had the safe harbor where as long as you restored those back to your prior levels by June 30th, you could get those reductions of forgiveness restored. Well, they've changed that now to where you have an option to go out to December 31st. Then we'll go over a little bit more of the nuances behind it, but that's high level. And then new exceptions for the FTE reduction is that you can, if you rehire employees who were employees of the eligible recipient on February 15th of 2020, or you hire similarly qualified employees for unfilled positions on or before December 31st, 2020, or you return to the same level of business activity as before February 15th. So these are ways that you can get your FTE reduction, quote unquote, penalty reduced. Okay, another item is that when this first came out, any people who had a remaining loan at the end of the day when they do their application, this was going to be a 2-year loan with an interest rate of around 1%. The revisions came out with the option that indicated that any new loans from June 5th beyond would have a 5-year term if there was a loan at the end of the forgiveness application. Now, if you had a loan before June 5th, it doesn't mean you're not eligible for 5 years. It means you negotiate that with your lender. So it's not guaranteed, but it is a possibility. So talk to your lender about that one. The other piece, which was kind of nice, is the PPP borrowers can now qualify for the deferral of the employer's share of payroll taxes. So many of us were having to rely on the rules that were out there, which defined that it was an either or. Now it's both. And then loan payments are deferred until the SBA determines the amount of loan forgiveness and remits to the lender. Now, the other piece, and we'll talk about this a little bit more later, they still haven't addressed whether the expenses that go into the forgiveness piece will actually be deductible at the end of the day. Now, we do know that the income piece will not be taxable income. So that's the known. But like I said, there's lots of unknowns. That's one of the key unknowns. That's a really important unknown we need to get in. As I mentioned, there's some interim final rules for the on June the 11th. And so that incorporates the 60% rule and extends the covered period.
Thanks, Colin. What's happened here is, as Colin mentioned, the SBA, once the CARES Act was signed into law in the end of March, the SBA periodically released new guidance over the past 2 months or so. And what's happening now is they're having to go back and revise any guidance that was issued before June 5th, which is the day that President Trump signed into law the PPP Flexibility Act, which extended the cover period, everything that Colin just talked about. So on June 11th, they just incorporated the provisions. Nothing else changed to the interim final rule. And then on June 12th, this isn't going to affect probably a lot of people that are listening, but it's worth mentioning. They changed, it used to be if a business had a owner that owned 20% or more, if he had been convicted of a felony in the last 5 years, you would not qualify. They've reduced that to 1 year if it's for, if the felony was for something other than fraud, bribery, embezzlement, or false statements. And the reason I bring that up, and Colin mentioned as well, you still have until June 30th to apply for PPP funds because there's still money out there. Okay, so there was additional revisions, and this is where we started seeing some new information. The third and sixth interim final rules were for self-employed taxpayers, but within the revisions, If you are going to, well, basically the default now is the 24-week cover period. And then if you got the loan before June 5th, you could make the election to use the 8-week cover period instead. Well, if you're going to use the 24-week cover period, payroll costs per employee is capped at $46,154. So you get to count the first 46,154. And then if for the 8-week it did not change, it's still 15,385. Owner compensation replacement, this is for self-employed taxpayers. I'll get to if you are a partnership, S Corp or C Corp in a minute to discuss how the owner compensation rules work for them. But a self-employed taxpayer, Schedule C business on filing on an individual's 1040 or a Schedule F if it's a farming business, you're going to be capped at the lesser of $20,833 or 2.5 months worth of 2019 net profit. And then if you use the 8-week cover period, you are still capped at 15,385. Okay, so right here, this was on Monday night, basically Tuesday morning. This is probably one of the biggest questions that has been asked since the president signed the new law that extended the cover period to 24 weeks. If I choose the 24-week period, can I apply for forgiveness when I use up all my funds, but I'm not at the end of the 24-week period yet? And the answer is yes. Basically, what it says here is the borrower may submit a loan forgiveness application anytime on or before the maturity date of the loan, including before the end of the covered period. You just have to use up all the funds that you were loaned from the PPP program. But one thing to watch out for, if you are going to apply before the end of your covered period, and for most people, this is going to be people that are borrowers that select a 24-week covered period, because I would assume most borrowers that have are going to use the 8-week covered period that has already passed or it's very close to passing. So this won't affect them. But if you're using the 24-week and you end up applying before the end of the 24-week, what it says here is if you apply for forgiveness before the end of the covered period and you have reduced any employee's salary or wages in excess of 25% in comparison to Q1 of 2020, you must account for the excess salary reduction for the full 8-week or 24 covered period. And I have an example that was directly from the guidance to show you how this will work. So you have a borrower is using a 24-week covered period. The borrower reduced a full-time employee's salary or full-time employee's weekly salary from $1,000 per week during the reference period to $700 per week during the covered period. So they've reduced their amount by $300, which is 30%. And it says the employee continues to work on a full-time basis during the covered period with a full-time equivalent of 1.0. In this case, the first 250, which is 25% of the 1,000, is exempt from the loan forgiveness reduction. But remember, they reduced that employee's weekly salary by $300. So the first 250 is exempt. The remaining $50, they're going to get dinged for it. And how that's work is the borrower seeking forgiveness would list the $1,200. And it's the $50 times 24 weeks. And right here in red, if the borrower applies for forgiveness before the end of the covered period, it must account for the salary reduction for the full 24-week covered period, even if you're applied sooner than the 24-week period. So just something to keep in mind. Here's example number 2. I'm not going to go over it, but it's the same math. It's just with an 8-week covered period. Okay, so as Colin mentioned, not only did they revise the loan application based on the new law that was passed on June 5th, they also came out with a easy loan forgiveness application. It's a one-page form. I encourage you to go look at it. If you're able to qualify, I would definitely use it because it's going to be a lot simpler. But here's the, I'm going to go into a little bit about how to qualify. So It applies to borrowers that are self-employed and have no employees. I assume most people that are on this webinar have employees, so I will ignore that part for now. Second, you have to meet one of these three. Um, second bullet point, did not reduce the salary or wages of their employees by more than 25% and did not reduce the number or hours of their employees. Or 3, experienced reductions in business activity as a result of health directives related to COVID-19, and again, did not reduce salary and wages of their employees by more than 25%. The good thing about using this form is there's significantly fewer calculations. You don't have to do the FT look back where you have to go figure out what the FT count is for the prior 2 periods if you're a non-seasonal, which would be the February 15th, 2019 through June 30th, 2019, or the first 2 months in 2020, whichever one's less. You don't have to go back and calculate all your FTs for those periods. So here's the top page of instructions for that easy form. And it says, you, the borrower, can apply for forgiveness of your Paycheck Protection Program loan using this form if you can check at least one of the 3 boxes. So you only have to check one of the boxes to qualify. And this is just going exactly over what I said on the previous slide, but in a little bit more detail. On number 1, self-employed people that have no employees. I'm going to skip that part. Assume most people on this call that doesn't apply to. So number 2, as mentioned before, you if you did not reduce people by more than 25% during the covered period when you compare back to Q1, and the second paragraph under checkbox 2, I think this might be a little difficult for some borrowers to meet. It says the borrower did not reduce the number of employees or the average paid hours or employees between January 1st and the end of the covered period. So the end of the covered period would be the end of your 8-week or 24-week period. And now that it seems like you can actually apply before your covered period's over, it'd probably be the date that you're applying. And if you did have reductions, there's some language or sentences that discuss some types of reductions that do not apply. But I'm going to go to number 3 because I think that quite a few people might actually be able to qualify for checkbox 3 because most of the people I've talked to did not reduce their employees' pay over the covered period by more than 25% compared to Q1 of 2020. So they would meet the first paragraph of checkbox 3, but the last paragraph on this page, this is something completely new. And it was part of the law that was passed on June 5th that Trump signed. It says the borrower was unable to operate during the covered period at the same level as business activity as before February 15th due to compliance with requirements established or guidance issued between March 1st and December 31st by the Secretary of Health and Human Services, the Director of Centers for Disease Control and Prevention, or the Occupational Safety and Health Administration related to the maintenance of standards of sanitation, social distancing, or any other work or customer safety requirements related to COVID-19. So just based on reading this, I know a lot of borrowers probably had situations where they can't keep as many employees at their location, maybe because of social distancing, and they have to reduce the amount of people that are there, or maybe the traffic that's coming through the business, they don't have as much people coming through the doors, so they have to reduce how many people are working, certain hours, etc. So the main thing is you're unable to operate at the same level as business activity during the covered period as before February 15th. And on the next slide, why that's important, because a lot of people might say, what does that exactly mean? Well, in the instructions, it says what documentation you'd have to provide to support this. You'd have to provide copies of applicable COVID retirement or COVID requirements or guidance for each business location and relevant borrower financial records. I put that in there because if you go back, it says you're unable to operate at the same level as business activity as before February 15th. I've actually seen some businesses that they're actually doing better during their covered period than they were at the beginning of the year, and that could potentially prevent them from qualifying for the safe harbor. I think we'll probably need a little bit more guidance from the SBA on what they mean by this, but I would assume if um, your financials are improving during the covered period, it might knock you out of this. But this safe harbor right here is actually applies also for the regular application, and we'll get into that in a little bit. And then lastly, there's an example that the guidance had on this. So a PPP borrower is in the business of selling beauty products both online and at its physical store. During the covered period, the local government where the borrower's store is located orders all non-essential businesses, including the borrower's business, to shut down their stores based in part on COVID-19 guidance issued by the CDC in March 2020. Because the borrower's business activity during the covered period was reduced compared to its activity before February 15th, due to compliance with COVID requirements and guidance, the borrower satisfies the Flexibility Act's exemption and will not have its forgiveness amount reduced because of a reduction in FTEs during the covered period. If the borrower in good faith maintains records regarding the reduction in business activity and the local government shutdown orders that reference the COVID requirement of guidance as described above. So basically this business shut down and they couldn't, for a partial time, they couldn't operate as they usually were. So they would qualify for this FT safe harbor, not just for, they'd still have to make sure to qualify for the easy form that they didn't reduce anyone's wages by more than 25%. But then also if this business couldn't qualify for the easy form, they would qualify doing the regular application where they wouldn't be dinged if they reduced their headcount because of COVID-19 essentially. So this can be very helpful for a lot of borrowers that are struggling to keep the hours up and whatnot at their stores. Okay, so the revised forgiveness application also came out, and the form is very similar to the original, but there's some changes. There's the new certification that I was just discussing. That is a new safe harbor for the FTEs. And then there's non-compensation costs clarified to paid or incurred. And then your the FTE and the salary and hourly wage calculation mechanics are the same essentially. Just some of the dates changed, and I'll show you that as I go through. But I'm going to do a little bit of a refresher, not too in-depth. I'm just going to highlight the areas where items change, and especially in the salary and hourly wage reduction. I'm not really going to cover that at all. I'm going to skip through a lot of it, but I have the slides in there in case you want to read over. And as Colin mentioned before, we do have prior webinars that are up on YouTube. If you want to hear us walk through how the steps work, you can go listen to those. But for the essence of time, we'll keep this short. Okay, so the cover period, as mentioned, it's now the default is 24 weeks, but if you receive your loan before June 5th, you can elect the 8-week cover period. The alternative cover period, if you have a biweekly pay schedule or more frequent, you can line your payroll cover period up with your pay schedule. So if you have if you receive the loan in the middle of a pay period, you can actually start your payroll covered period on the first day of the next payroll cycle, and then it lines up nicely. This only applies to payroll costs. It does not apply to non-payroll costs. Cash compensation, nothing really changed about this. Just keep in mind it's paid or incurred. And I have an example how this works. There's a lot of misconceptions about how this works. And also, as mentioned earlier, if you're using the 24-week covered period, you now can count up to $46,154 per employee. That's just 24 weeks divided by 52 times 100,000. Okay, limitations on amounts paid to owners. Actually, the revised application did shed some light that S Corp owners will be subject to this. They were mentioned. So owners are defined as C Corp, S Corp, owner, shareholder, employees, a self-employed individual or general partners. If you're doing the 24 weeks cover period, you're going to be capped at $20,833 for each individual, or the 2.5 month equivalent for their applicable compensation in 2019. Key here is whichever is lower. This can actually hurt people based on how the rules are written. If you started your business in 2020, you didn't have any compensation in 2019. So based on how they're written, it seems you cannot include that compensation. And then also if you brought on new owners or had just changes in ownership, the new owners that come on, based on this, it looks like their compensation will not count as a eligible payroll cost because they were not a owner in 2019. And this cap is across all businesses. Okay, applicable compensation in 2019. So what is applicable compensation? Because in the previous slide, I mentioned 2.5 month equivalent of their applicable compensation. Well, here's what it's defined as. If you're a C Corp owner employee, this came out on Monday night. 2019 cash compensation plus the employer paid portion for retirement and health insurance contributions. If you're an S Corp owner employee, it's going to be your 2019 cash compensation and your employer retirement contributions made on the S Corp shareholders' behalf. Keep in mind here, you do not get to include employer health insurance contributions because they should already be part of your cash compensation. If you're not aware, if you're an S Corp and you have S Corp shareholders, they're more than 2%, you have to include their health insurance that's paid by the employer as a taxable fringe benefit in their W-2. A lot of payroll providers actually exclude it if they're not alerted to that. And then that shareholder would take a deduction on their individual return for self-employed health insurance. Okay, general partners. It's going to be your 2019 net earnings from self-employment reduced by 179, unreimbursed partnership expenses, and depletion from oil and gas properties. You're going to multiply that sum by 0.9235. Okay, costs eligible for forgiveness, payroll costs. Nothing's really changed about this. It's the same. You get to include the employer's contributions for health insurance, retirement plans, and then also the employer's state and local taxes paid on employee compensation. It's like if you're in Texas, it's going to be the Texas Workforce Commission that you pay on unemployment. Okay, payroll costs. When do they have to be paid? As mentioned before, paid or incurred during the covered period. Paid is when the borrower paid means when the paychecks are distributed or the borrower originates the ACH credit transaction. Payroll costs are considered incurred on the day the employee's pay is earned. So this is important right here, and this is where a lot of people have gotten tripped up when reviewing calculations. Payroll costs incurred but not paid during the borrower's last pay period of the covered period are eligible for forgiveness if paid on or before the regular payroll date. I have an example to show you that Colin mentioned earlier. It's about 10 weeks that you get to count instead of 8, and you'll see how this works. And just at the bottom, you can't double dip. Okay, so paid or incurred example. You got your loan on April 10th. You're using the 8-week covered period, so that's going to be the 56th day is going to be June 4th. This borrower is a semi-monthly borrower, and they're one pay period in arrears. So if you look at this right here, wages incurred March 16th through March 31st. Those were incurred before you received the loan, but you actually paid it after you received the loan. You get to count that because it's paid or incurred. And then if you look towards the end, May 16th through May 31st, that'd be paid on June 15th. You get to count that because the wages were incurred during the covered period and they're paid by the next regular pay date. And then as well, June 1st through the 4th, you have 4 days in June that were incurred and then they're paid by June 30th. You'd be able to count that as well. So what happens is you get about 10 and a half weeks So this is when they came out with paid or incur, that's very favorable. It was I initially thought that it might be paid and incurred, which would be cash basis essentially, but it's not, it's paid or incurred. Okay, costs eligible for forgiveness, non-payroll costs. This is essentially the same, nothing's changed. Just keep in mind interest payments, you cannot count the prepayment of interest or the payment of principal. Rent, if the lease agreement's in place before February 15th, you get to count it. And then business utility payments. I know a lot of people have asked about transportation. What does that mean? I wish I had an answer for you, but they haven't really issued anything. So this is what we got at this time. And one other note, a lot of people have asked because especially because the non-payroll cost is now 40% is what it can be. Your forgiveness amount can be 40% non-payroll costs. People have asked, can I prepay my rent? Currently, there's nothing that prevents it. That's not to say there won't be something issued in the future that could prevent it, but currently the only thing that's prevented is mortgage interest prepayments, because the paid or incurred rules, as I spoke about for the payroll costs, work the exact same for non-payroll cost. Okay, so how much the loan will be forgiven, it's going to be determined on how much of the loan was spent for payroll costs and non-payroll costs. I have something special at the end for everyone. I would stick around because you'll see that if you use the 24 weeks, there's an interesting scenario that's coming out where you could basically, you'll just have to wait to see how the math is working out, but it's something that definitely is an unanswered question we'll have to get to. Okay, so your non-payroll costs are capped at 40% of the forgiveness amount now. They used to be 25%. And as mentioned in previous webinars, your forgiveness amount could be reduced if you reduce your employees' wages or you reduce your headcount during the covered period, but there's a bunch of safe harbors that are basically get out of jail free cards that help you out. And then lastly, if you had an EIDL loan, it will reduce your forgiveness amount. And as I mentioned, this is just the worksheet from the regular application. You won't actually have to do this for the easy calculation, but I'm going to briefly go through the salary and hourly wage reduction. I'm not going to go into any of the details really, just highlight the major changes. But big picture, what this is if you look at how much you pay your employees over your covered period, and if it's 25% less, I'm sorry, if you've cut their pay by more than 25% in comparison to Q1 of 2020, you could run into problems where you could have a reduction. And you only have to test people, employees that you do not have to test are any employees that earned over $100,000 annualized for any pay period in 2019. So here's the steps. And there is a safe harbor. I'm not going to go into it, but I will mention the date used to be June 30th. The application's now changed it to the earlier of December 31st, 2020, or the date the application is submitted. So that's regarding if you do a reduction to your employees' wages, you essentially have longer to restore that reduction. And these slides, they're just information. I show you where I've changed it from June 30th to December 31st. And just to stress this again, all these rules have changed apply if you're using the 8-week or 24-week period. The only thing that's changed really is you now have the option, if you got the loan before June 5th, that you can now use, you can elect to use the 8-week instead of doing the 24-week, but all the other rules are the exact same no matter what covered period you'd select. Okay, these examples have just been updated for 8 or 24 weeks. I'm gonna fly through them. They're informational. Okay, we're gonna go over the FTE calculation, I think this is probably the most challenging part of the application if you have to do the regular application. So if you are doing the regular application, you have to provide an average FTE for not only the cover period, but also some look back periods. So what is an average, or yeah, what is an average full-time equivalent? So what you have to do is you have to determine the average number of hours worked per week for each employee. And then what you're going to do is you're going to divide their hours worked by 40, and you're around to the nearest tenth. So if you have someone that works 40 hours, 40 divided by 40 is 1.0. Someone works 50 hours, 50 divided by 40 is greater than 1, but it's capped at 1.0. Let's just keep that in mind. Alternatively, you can elect to use a simplified method where everyone that works 40 hours or more per week is a 1.0, and any employees that work less than 40 hours are a 0.5 full-time equivalent. So here's the example. You have 5 employees. Employee A, he's working 50 hours a week. He works more than 40 hours, so 50 divided by 40. It's greater than 1.0, but you only get to use 1.0. And then you can see the fractions for people that are working less than 40 hours, how it comes out. And it gets rounded up to the nearest tenth. But I have another example of how this works a little bit. I guess the only thing I'll say in here, I think it's worth it to do the simplified method as well, potentially, because if you are running into issues where you do have reductions due to the FTE, it's worth it to run both scenarios if you can, because one might turn out a better result for you overall.
Yeah, I'll chime in there, Denver, on that. I thought that the FTE route for counting partial FTEs would actually, not the 0.5 but partial, would result in better results from the FTE perspective. But surprisingly, on the couple that I've run through, they've either been close or simplified. It's actually been a little bit better. So every scenario is different, and I know it's a little bit more work, but that's certainly something to look at. And then there's also some shortcuts where instead of having to do it for every week, you can do it for the entire week, for the entire period, and then divide it by your 40 hours full time to get you there.
One thing to note on this, and this was actually, I can't remember if this was in the guidance that was issued on Monday night or if this was on the revised application, but it is in one of them. It's important to note that, this is based on the application, I apologize. The FTEs are based on hours paid rather than hours worked. So if you are paying someone that you have furloughed, but they're not actually working hours, you would still presumably get to count them as a full FTE. I would probably count them as a full FTE if it was me doing the application. Okay, so this FTE reduction exception, there's been a few questions on how that all works. I'm going to go into that. It's on the worksheet where you can put a number there and this FTE reduction exceptions is only for the employees that were employed during the covered period, as you'll see. So how do you get an FTE reduction exception? If you have any positions which the borrower made a good faith written offer to rehire an employee during the covered period or the alternative covered period, which was rejected, meaning you probably let someone go or someone got fired before you got the PPP loan proceeds, and they're like, I need to rehire people to get my head count back up. And if you provide them with a good faith written offer to rehire and they rejected you, that person would count as a 1.0. Then secondly, if you had any employees who during the covered period were fired for cause, voluntarily resigned, or voluntarily requested and received a reduction of their hours, you would get to count them as well. But for both 1 and 2, you only get to count them if you did not refill the position with a new employee. And this is important in a second. You'll see the example how it could be interpreted different ways, and it does make a big difference. So here's our example. The borrower has 2 employees, Rachel and Monica. At the beginning of the 8-week covered period, Rachel works 40 hours per week throughout the entire cover period, so she's going to be a 1.0. You have Monica, who works 40 hours per week for the first 2 weeks and is fired for cause, so she's a 1.0 for week 1 and 2, and then she was fired for cause. You have Chandler is hired at the end of week 3 and works 5 hours. For that week, he works 35 hours per week for the remaining 5 weeks. Then you have Joey is hired in week 7 to replace Monica. Joey works 40 hours per week in week 7 and 8. On the next slide, I have the hours based on the employees. The main thing before I flip to the next slide to note here is that Monica was fired for cause, and then Joey replaced Monica in week 7. So let's see how this works. Okay, hours worked at the top, just reiterating what was on the previous slide. So based on the language, Rachel, I'm on the based on the language, the PowerPoint slide from that one. So Rachel is a 1.0 for all weeks. Monica would be a 1.0 for week 1 and 2, and then she'd be 0 for all other weeks. Then you have Chandler, who is a 0 for week 1 and 2 because he was hired in week 3. He worked 5 hours in week 3, so 5 divided by 40, that's where you get the 12.5. And then in week 4 through 8, he worked 35 hours a week. That's where the 35 divided by 40, that's where the 87.5 is coming from. And then you have Joey, who worked 40 hours in week 7 and 8, who was hired. So if I go back to right here, it says in all these cases include these FTs on this line only if the position was not filled by a new employee. So right here, Monica's position was refilled. So based on the language, we can't count her as a 1.0 for week 3 through 8. And the questions come up a lot. Should Monica count as a 1.0 until Joey is hired? I think based on how the language is written that you would not be able to count her as a 1.0, because if you look how the worksheet's working, you have to put a 1.0 that Monica was for the whole covered period. And if you did the math here, she actually would not be a 1.0 for the whole covered period, because in week 7 and 8, she would be 0. So that begs the question, you can see the FT average at the bottom at each one, and I apologize, I forgot to round to the nearest 10th, but if Joey was hired for a new position and did not replace Monica's position, you can see how more favorable the FT average is for that. You get a 2.8 versus if Joey is hired to take over Monica's position, you only get a 2.1. So this could be significant, but this is how it all works. And then now we're going to talk about, this is where you can get hurt the most on your forgiveness, because remember what you're doing here is you got loan money, you went and spent it on payroll and non-payroll costs, you add up all those costs over your covered period, and now you want to go and apply and get that forgiven. Well, wait a second, if you cut your hours of employees, it can actually hurt you and reduce the maximum amount that can be forgiven. And how that works is what you have to do is you have to go back, and this is only for borrowers that are doing the regular application. If you file the easy application, this does not apply to you. And this is what I was saying, there's less calculations, but if you're doing the regular calculation, you would have to go back to February 15th, 2019 to June 30th, 2019, or the first 2 months in 2020, figure out what your FTs were for each of those pay periods and average it out, and you choose the lesser of. Or if you're a seasonal employer, you could also do what's stated on the slide. But what happens is you take your FT count over the covered period and compare it to the lesser of the first 2 bullet points. And if those look back periods, whichever one you choose of the 2 bullet points, the February 15th, 2019 to June 30th, 2019, or the first 2 quarters in 2020, whichever one is less, you choose that. If it's still greater than the covered period, you're going to have problems because your forgiveness amount is going to be reduced. However, they make this pretty complicated, but to your benefit, there are 2 FT reduction safe harbors that would prevent this reduction from occurring. And just how the math works on assuming that this borrower does not qualify for either FT reduction safe harbor, if you had 10 FTs during the 8-week covered period after you received the loan proceeds, you look back to the prior 2 periods and you have 16 FTs. 10 divided by 16 is the FT quotient of 0.625. So basically all your costs, your eligible payroll and non-payroll costs, you're going to multiply it by 62.5. And that's what you would, it gets a little bit more complicated, but your forgiveness amount would essentially be limited to that. It's a little bit more complicated than that. You'll see in a second. And yeah, so it's a 37.5 reduction in all the expenses you paid out. You don't get 37.5 of them forgiven. That can be huge. So here's the first safe harbor. I spoke about this earlier. This is, I think a lot of people will, or a lot of borrowers will probably be able to qualify for this. And this is the same one from the easy application as part of the new law that came into effect on June 5th. Basically, if your operations were down over the between February 15th and the covered period compared to before February 15th, or you're unable to operate because of COVID-19, you wouldn't be affected by an FT reduction. You're going to be exempt. And then this again, documentation you'd have to provide. Just remember, it looks like if your business activity increased where you became more profitable during the covered period, you might not be able to qualify for this. I would definitely talk to your CPA, lender, attorney, and get their opinion on this if you actually need it, because to be able to qualify for this could be huge if you don't have to get hit with the reduction. Okay, here's FT Safe Harbor reduction number 2. This is the one that used to have the June 30th date, and it's been changed to not later than December 31st, 2020. The main thing here is your FTs, you look at them at February 15th, and then you compare it to the time span between February 15th and April 26th. This is important. You have to have a reduction between February 15th and April 26th compared back to February 15th to be able to qualify to meet even the first part of this safe harbor. And the second part is you have to restore that reduction by not later than June 31st, 2020. And this is how the math works. If you had 15 people on February 15th, then February 15th, April 26th, you had an average of 10. So you did have a decrease. As long as you get your FTs up by 15, you would be exempt from the FT reduction as long as it's before December 31st, 2020 or earlier. What's kind of interesting is I've actually heard some people ask the question, what happens, like I was going off that June 30th date, what happens if I get my count back up by June 30th, but then like later in the year before I apply for my forgiveness, my count goes down, will that affect me? I don't think anyone knows the answer to that yet, but that's a great question if you're in that scenario. Hopefully, as long as you get it up to some time period later, it won't affect you, but I'm not sure yet. Okay, determining final forgiveness. This is different than the easy calculation because the easy calculation, you have no reduction in salary and hourly wage reduction or FT reduction. But how it works is when you determine final forgiveness, you take the lesser of your total payroll costs and non-payroll costs, or the PPP loan amount, or your payroll costs divided by 40%. It used to be 75%. So that's very helpful on the third bullet point. And then lastly, before I turn it back over to Colin, so the loan forgiveness process, a lot of people have been asking now that they're past the 8-week period and they just want to file for the application. So how it's going to work is the lender has, when you submit your application to the lender has 60 days from receipt of complete application, keyword complete here, not partial application, to issue a decision to the SBA. The decision It could be approval, denial, or a denial without prejudice due to pending SBA review. If you are denied, you can request the lender to reconsider unless SBA's determine you to be ineligible. And then lastly, if the borrower does not apply for forgiveness of the loan within 10 months after the last day of the covered period, the PPP loan is no longer deferred. The borrower must begin paying principal and interest on the loan. And then, oh yeah, so a lot of people have asked, like, how do you find all the information that to keep up to date on all this? If you're really curious and want to stay up to date as possible, if you go to treasury.gov and then on their homepage to the top, you can't miss it. In red, you'll see you can click a link to see information about Paycheck protection loans. Every time they update guidance or issue something new, they will publish it on their website. But usually first it comes through Twitter and then it goes here. But okay, Colin's going to take it from here.
Appreciate you working through all of that, Denver. We brainstormed a little bit on what are the key items where we've talked with our contacts who are already working through scenarios on forgiveness to help identify, what are the key things that we found that they could tweak in the way that they're doing their consideration that would actually help them in that analysis. In some cases, it's something that maybe it's being done incorrectly, they could tweak. So the first item was that when you're doing your cap, so that 15,385 during the 8-week period, of course, it's higher in the 24-week period, that amount times 4. When you do your analysis, I've seen many cases where the cap is being considered on a weekly, like on a per paycheck basis. And while that does make sense, since there are some ebbs and flows in pay, that could result in including too much compensation as in more than 15,385, or it could result in less than. So we would recommend that you use a formula that basically includes the gross pay from the first paycheck and then adds the second and adds the third, and you keep adding until you hit that limit. And then you don't include any more for that employee. So that's a best practice number one, we think would be helpful. The second one, Denver has talked about, and we went through some good examples. It's the paid or incurred for payroll costs and non-payroll costs. Just make sure that you're looking at any expenses that you pay, eligible expenses that you paid during that 8-week period. And then at the end of it, you look and say, well, are there any expenses that could be your utilities, like your payroll, not your payroll, any utilities like your water, sewer, electricity, phone, etc., that are usually in arrears. Look at those, accrue them. Look at your payroll. Are there any payroll that's been paid after the fact, or 401k contribution attached to that payroll? Other things like that actually apply to that 8-week period or the 24-week period. The other one is the FTE calculation. There have been a couple of questions in the Q&A. Remember, when you're doing your FTE calculation, if you have people who if you furloughed them, yes, that's a reduction. But if you hire them back, that can help. Now, if you fired somebody for cause, or they quit, or they retired, or you furloughed them and then you attempted to rehire and they replied back to you with a no, I'm sorry, I'm happy with either a new job I've gotten or I'm happy being under unemployment. Those are not reductions. And so you can consider all those different areas. If you look on page 5 of the forgiveness instructions, it's very helpful. And it helps guide you on these exceptions that are there. And then the next one is the wage reduction calculation. So if you have people that are hired or fired during the covered period, there's some quirky rules there. So make sure that you're kind of considering how you're doing those calculations here. And then the reduction, if you have an hourly person, so if you have an hourly person but you've had to reduce hours, that doesn't mean that you have a payroll reduction. For hourly, you're looking at their wage rate. So if their wage rate wasn't reduced, but you had to reduce their hours, You would be affected by more of the FTE reduction, but you wouldn't be affected by the wage reduction as well. So that's kind of a double whammy that you actually are not affected by. Okay, others would be still using the 25% non-payroll cap instead of the 40%. And then of course you've got that's June 30th, which is what we all knew. And then you have the second piece, which is the December 31st or a period before December 31st where you were able to restore payroll and restore your FTE. Those are some of the common mistakes. So I would definitely encourage you to focus on those areas. Let's go into some common questions or frequently asked questions that we've dealt with as well.
Hey, Colin, this is the
Sure.
one that I slipped in that's
All right.
actually a big, I think it's probably the biggest unanswered question. It's actually kind of interesting because people are, as they're doing the math, they're figuring out, hey, they're thinking if I do the 24-week period, I'm gonna have so much more in payroll and non-payroll costs that even if I have a FT quotient reduction, it's not even gonna affect my calculation at all because the modified total will still be greater than the loan amount. I think there's got to be something that comes out later on this because the main reason they extended it to the 24 weeks versus the 8 was because a lot of businesses were closed down. They couldn't actually spend their money. But now that using 24 weeks or about 6 months, they have more time to spend their money. But there is an interpretation that based on how it's written now, well, I'm just going to count my total payroll and non-payroll costs incurred over the cover period, regardless if it's in excess of the loan amount. And if you're able to do that, if you go through the examples and you'll have this slide, you'll see you can actually come out to a very favorable position if you're able to do this. And if you do have an FT reduction, you can possibly have it not even affect you. We'll have a watch out to see if anything comes about this.
Absolutely. That's one we've been getting a few questions on, and it's like, well, we're not entirely sure. Hopefully that's the case. I do want to throw one question that's been put out there. I think it's a very good question here. So let's just say, for example, that you have to get in this perfect example. I'll just read it. If you have an FTE penalty, so it takes more dollars of eligible costs to achieve loan forgiveness. So let's just say you got a $1 million loan, and you have eligible expenses, but part of it gets reduced. And let's just say in this scenario, you get 800,000 that's forgiven, but you had to use $1 million of expenses to get there because of that reduction penalty. Do you lose the whole $1 million in expenses as deduction, or do you lose $800,000 of expenses as reduction? And while I haven't necessarily seen that addressed, Joe, what I would expect is that since the rule is that you can't deduct expenses for something that is not considered income, I would think you wouldn't lose the $1 million, you would likely lose the $800,000. So therefore, the expenses that you would lose would match your forgiven amount. So that's my thought. Denver, do you have a
Wait,
opinion
I'm
on
sorry,
that?
I missed the first part. Was he asking if if it's $1 million loan they receives, but only 800,000 is forgiven? What happens to other?
Not because of not having the expenses, but because of the reductions of either FTE or actual expenses. So you had $1 million of expenses to get you 800,000.
Oh, that's an interesting question. I think the law said that it's any expenses that were forgiven, but yeah, I don't know the answer to that. That's an interesting question.
All right, so we're going to go into these commonly asked questions. The most common, honestly, that we get is, how do I get help? Because this is definitely complicated, and either A, you just have a lot of questions, or B, you want to work through scenarios. And the answer is, I mean, we can absolutely help you. We're helping quite a few clients at various levels of depth and needs. So yeah, think of us. We'd happily help you out. We're already working with quite a few of our clients, and even those that are not our clients in this process. Now, if I am going to use the 8-week period, can I apply immediately after the 8-week period is over? And the answer to that is, we thought, but the reality is that you need to ask your bank, because we're hearing that some banks are not going to be accepting applications for some time. It might be a month or it might be a few months. They have to get their house in order. The question then would be, if you have everything ready and you're ready to get this application in and you're ready to get the date of my application firm, because the new application does ask for the date of your application of forgiveness and the number of people there. And they're not going to accept applications for a while. Does that mean that you can complete an application so you can get everything firm and you can get the process out of the way, but then know it's just not going to be processed until later? I'm not sure. I would hope so. But again, it's reaching out to your bank and finding out what they will allow you to do. The next one was, if I'm doing the 24-week period, can I apply for forgiveness before the 24-week period? Let's say that you're able to get enough expenses in after week 11 or 12. I know Denver talked on that a little bit, but I think the answer is before, I think, Monday. The answer to that was, we don't know yet, because everything is saying 8 or 24. It appears now that you can apply at a time between the 8 and 24 week if you're on the 24-week period. You don't have to wait until that full 24-week period is up. Because there's some quirks. If you do the full 24 weeks, you do have some, if you're on a GAAP financial statement, that's expense, and your forgiveness is not considered income until approval's been received. And the same thing for tax. If this flows over to between 2 tax years, you have the expenses, do they become non-deductible in 2020 because they're going to be forgiven in 2021, which is not a taxable item the other way? It gets very quirky, very complicated. So something you should definitely consider. The next one, we debated including this in here because the answer to this has always been no, but we keep getting questions on it. Can I include 1099 contractors? Remember, 1099 contractors were eligible to apply for their own PPP loan. So therefore, you cannot include them. However, there's instances where you could convince them to come and become full-time employees, and therefore they are W-2. So maybe you could. Now, obviously, if there's somebody that had the qualification and description that maybe they should have been W-2, that opens up a different can of worms, and I'm not really going to go there, but something to consider. The next one is, can I record an estimated forgiveness amount in my P&L? And, I guess if I took my consulting hat off and I put my audit hat on, I would say you can't until you have notification. If you're trying to do it from an operating perspective, I would think you probably could. The question I would ask you is, how does that affect the impact of your evaluation of your performance? I would think that you would probably, if it was me, I would probably not record it, because I would want to know how my business performed without the PPP loan. I would want to know what I thought my forgiveness would be, so I could see, well, what is it going to look like with this assistance? But again, I think everybody has to consider that independently. I would say that if you end up deciding you want to record an estimate or actually record it, you need to make sure that you're not having adverse effect on anybody's pay plans or bonuses or any other items for this handout that you're getting or this assistance you're getting. Next one is, while I understand the forgiveness is non-taxable, is there any chance I'll be able to deduct the underlying expenses? Denver's already addressed that earlier a little bit. I think it's something that, the optimist in all of us, we should hold out hope that you'll be able to deduct the expenses as well. Don't hold your breath. There's enough discussion about it. There's people that wanted that to happen. But that has not been a priority, and I'm sure we'll probably find out one way or another, either by the end of the year or by the time tax returns need to start being filed in 2021.
Hey, Colin.
Yes.
On that one, the answer is no right now. You can't deduct the expenses for the portions forgiven. Maybe I'm a little pessimistic about this, but I think it's interesting that both sides of the aisle, they um, brought that issue up. And then when they passed the legislation on June 5th, nothing about the expenses being deductible was included. So, I mean, I'll always hold out hope, but I don't see it happening. But yeah, the one last thing that's kind of unrelated that I'll mention, if you are doing quarterly estimates for owners and you're including the expenses right now and you're doing it off 2020, but you haven't brought in the income yet that will be non-taxable, those expenses are probably non-taxable or non-deductible as well. So you'll have more income. So just keep that in mind.
All right. I guess I would ask our assistant panelists here if there were any other questions that they came across and answered that they thought would be helpful to go ahead and address live as well.
Okay, the other one that came up was if they've received their loan more recently, are they required to use the 24 week period versus the 8-week period?
Yeah, if more recently, as in, I think the date was June the 5th. So if they receive the loan proceeds June 5th or later, the 8-week period is not an option. Now, if you remember the 24, so you would be under the 24-week period, but that does not preclude you from applying before that 24-week period is over, based upon the new guidance. There's a question about you received the funds. Do you have to, I've seen this question a couple of times now. Is it automatic in going between the 8 and 24 week? It's on the application. I believe you're making that election there. I don't think you need to do an extension or anything, although I haven't heard anything other.
This guidance they just came out with was after the application, so I don't know if they're going to revise the application again.
Right. I think that's actually a good thing to put out there. That's the thing we don't know. This is the second round of applications. There might be a third, there might be a fourth. This is what we have for now, though. As mentioned before, if you've got other questions, we're happy to assist you. On here, it shows the email address, askus@lgt-cpa.com. If you're already working with folks at LGT, feel free to reach out to us directly, and we'll work with you at getting guidance as well. So we appreciate you coming. Certainly glad you joined us, and we will hopefully work with you or talk to you soon. I'll take care.
Thank you for joining us. As the situation is constantly evolving, please make sure to follow our events page for more information. The link is in the description below, along with other important links, including our social media. If you want to see more of the past Lane Gorman Trubit COVID-19 financial webinar series, subscribe and hit the bell icon for notifications.